Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the new trading year will certainly not be without new challenges, and our Zacks experts are going to weigh in on some of the challenges they feel investors need to know about. Research Director Shiraz Mian, Tracy Reinick, who's our value stock strategist, and our ETF Research Director Nina Mishra join me now. So, weather's not the only challenge, apparently, so far in this new year. Shiraz, you actually feel that one of the biggest challenges is going to be to get the validation for all of the gains that have been pocketed so far. Now, where's that going to come from?
Well, it's supposed to come from a ramp up in economic growth, which is supposed to translate into stronger earnings growth. And that's been the hope that everybody's been banking on, and that's what's been driving stocks. I mean, obviously, the Fed was a huge support for stocks and still remains a huge support for the market. But underlying the optimism that everybody had for the stock market was this notion that good times were ahead. Yes, economic growth was kind of so-so. Yes, there wasn't much earnings growth, but everybody was looking ahead and saying that in 2014 will bring us double-digit earnings growth. 2015 will bring us double-digit earnings growth. And we need to see proof of that now.
Okay. So you mentioned earnings growth a few times. I heard you. Nina feels that earnings growth is going to be a challenge, right?
Yeah, with low interest rates, almost zero interest rates, companies had a good time in growing their margins. It's going to become tougher when interest rates go up. And of course, there would be other new challenges in the market and things that could go wrong and bring down the rally this year.
Tracy, you're looking at valuations as a challenge, but is that a carryover from 2013? Wasn't valuations kind of like at the end of 2013 becoming a question?
Yeah, to some extent. I mean, when you have a big run-up like we had, it's going to be hard for people like me to find the value out there.
Yeah.
You're going to need earnings growth. But, you know, I'm in the camp that we might see some surprises this year on the earnings side, maybe not from North America, actually, where I do think things are starting to ramp up, but I think maybe from Europe, because we've been getting a couple earnings reports in even this week. You know, obviously it's for 2013 still, but I mean, they're all saying, surprisingly, and these have been industrial type companies, that Europe is starting to turn around. So if we can see even that continue through 2014, it might be enough to boost up the earnings growth, at least for the multinationals.
Yeah, they're saying look at Southern Europe instead of emerging markets in this year.
Yeah, growth is still uneven in Europe, but Germany, Sweden, UK, and Ireland, these countries are doing pretty well. Spain and Italy are also doing well now. France still remains probably the sixth child of Europe, but still Europe is picking up, and Japan is doing very well this year.
Since we're all talking about growth, what about jobs growth? Anybody feel that that poses any kind of a challenge? We did get some good news as we sit here and tape this morning.
Yes, yeah, I think the job picture is improving. The last monthly jobs report that we had for November, which was before the Fed meeting, perhaps pushed them over the cliff to announce the taper. And this morning's ADP report is, if it is a good preview for Friday's jobs report, should bring us good numbers too. So the overall economic data lately has been on the positive side. When Q4 started, the consensus view was for about 1% GDP growth. Right. And that has steadily been inching up, and now it's close to 3%. And if we do get 3% GDP growth, which we should have the first read in a couple of weeks, that'll mean that the second half of 2013, the growth pace was almost double what we had in the first half. So maybe that hope that you have, Tracy, of positive surprises on earnings and revenue driven by the economy may come true. Who knows?
Tracy actually feels that irrational investor exuberance is going to return.
Oh, yeah. Well, if we start to see this kind of melt up, you're kind of seeing it a little bit in housing, you know, a lot of double-digit gains in that last year, and suddenly people are like, ooh, I might be able to flip now, I can start doing crazier things. We saw the big gains in the stock market the last couple of years, but now it was really big into the news towards the end of the year because the rally continued. So yeah, I could see a scenario where we have this melt up. The jobs numbers are coming in better than expected. You know, a lot of these asset classes are hitting new highs. People feel real good when things hit highs, and we see kind of like a melt up scenario.
So what about rising interest rates?
Rising interest rates will definitely hurt some sector. They have already started hurting housing. And I think utilities, telecom, staples, bond-like sectors, they are not going to do so well in rising interest rate scenario. But there are other sectors like industrials, like insurance, and regional banks, which benefit from the rising interest rates and steepening yield curve scenario. So probably it is time to look at those sectors. And technology too.
And in the surprise column, you actually feel that there are some things that can still go wrong.
There are a lot of things which could go wrong.
That's a surprise.
Well, China remains a wild card.
That's right.
You never know what's going on over there. And there may be a credit crisis, but we do not know. I think the People's Bank of China has the means to prevent any significant credit crisis, and maybe the credit squeeze that occurred last 3 times, maybe it was engineered by them, but you never know. And they are trying this big transition from investment-led to consumption-led growth, and that transition may not be smooth. We can get some bad news out of Europe. Tapering may not go smooth, like we saw in May. So Fed's communication policy is going to be very important. So, and there are a number of other factors too.
Okay.
I think if the interest rate rise is accompanied by strong economic growth along the lines of what we were referring to in the second half of 2013, then the stock market would be okay with it. But if the interest rates keep rising while economic growth is just so-so, then it'll be a problem.
Okay, thank you all for that. There you have a little bit of a thumbnail sketch about some of the challenges that may lie ahead in this new trading year. Now, what does lie ahead for sure are top stock picks for the week from these folks. That is in our next segment.